Well, greetings everybody, and welcome to one of our special, this is an inaugural main event. We're dubbing it Successful Investing 1 with a subtitle, Investing Before, During, and After a Storm. It's been nicknamed the COVID Cancellation Conference, and we're just really pleased to be with you here tonight. My name is Mark Robertson. I am founder and managing partner of Manifest Investing. I'm joined here by some really cool friends that are awesome investors and just a joy to work with. Kim Butcher of Florida, Pat Donnelly of Pittsburgh, Cy Lynch of Atlanta, and Hugh McManus from Pasadena, California. And what these people all have in common is just a track record of solid investing, and just they all love to share ideas, and that's what we're here to do here for the next hour or so. Last but not least, I'm going to hand over to Ken Kavula, one of our fearless leaders in the realm of investment education. And Ken, why don't you go ahead and take things away?
Well, thanks, Mark. We've had a lot of questions about this name, COVID Cancellation Conference, and it came from the fact that Mark and I, and many of you know that we travel around the country speaking to chapters, small chapters, big chapters, and those in between. We love to do it. It's a great way to see a lot of you face to face and to spend a day talking about investing. But with this COVID virus this year, we've had to cancel perhaps 5 or 6 events all the way through August. We've had to make cancellations. So we decided about 2 weeks ago that we'd pull together a virtual conference to make up to those chapters some of the things that we aren't able to do in person this year. This is an educational. Mark, I'm trying to move the slide myself and it won't go because
I'll help you out, Ken.
Thank you. Okay. Here's the legal stuff that we have to get through real quickly. We are going to talk about real stocks in real time, and I'll get back to that in just a moment. But please remember, everything we say are for educational purposes only. We're using the stocks to illustrate various points. We might own these stocks in our own portfolios, and if we do, we'll try to let you know that. But basically, this is an educational presentation. Please do your own homework. And buy or sell these stocks depending on what your opinion of them is, not what our opinion is. If you'd like event email reminders about programs coming from Mid-Michigan Better Investing and Manifest Investing, please drop a note to N Kavula1. That's my wife, Natalie. She's maintaining a mailing list. It's up to about 1,300 or 1,400 people right now. And she'd love to add your name to the list. All we'll do is we'll remind you when our events are coming up and give you the opportunity to register for them if you wish. Remember that if you'd like copies of these slides, send an email to markr@manifestinvesting.com, and Mark will give you a copy of the slides from this evening. So let's go to the next slide, Mark. The conference itself is made up of this opening panel. This panel has traditionally begun the Better Investing National Convention now for the last 7 or 8 years, and prior to that it was an integral part of the convention. It had its beginnings back in 2008, and we'll talk about that in just a little bit as well. Along with the panel, we'll be teaching 2 classes tomorrow: Small Company Discovery and Bear Market Lessons, and then 2 classes on Saturday: Portfolio Management, Better Selling, and a few of our favorite screens. At one point or another, all of the panelists are going to be involved in teaching parts of various classes. So join us for as many of these classes as you can fit into your schedule. You've already been sent links to these classes, so just click on the link and do the registration, and you'll be registered for whatever interests you going forward. Next slide, please, Mark. We've been doing this since Schaumburg in 2008, and we're kind of proud of the results. None of the panelists on tonight's panel have been on every single one of the panels, but most of us have been on a majority of the panels over the years since 2008. And the choices that we've made have netted a 9.5% annualized return versus 9% for the Wilshire 5000. So our picks have actually beat the Wilshire 5000 over the long period. Not by as much as we'd like, but a win is a win and we'll take it. The collective rate of return for all of our picks in 2008, 9, 10, and all the way up through last year, the collective rate is a 12% return versus 10 for the general stock market. So again, we're ahead of the market with our picks, and that's pretty good for a bunch of folks trying to have a decent time and coming up with some stock ideas for an audience to consider. We did leave some room for improvement, hence the graphic of the Hindenburg up on top of the slide. Last year was not one of our better years, and you can see what's happening to some of the stocks we chose. I don't know who picked Norwegian Cruise Lines, but it has the distinct honor of being one of the biggest losers we've ever chosen before.
Ken, I know who picked British Tobacco.
I do too, Mark, okay? And I'll give Mark credit. Even a blind squirrel catches a nut sometime. So,
I thought the Hindenburg was my picture. Thank you.
Oh, okay.
I just know it wasn't me.
All right. So Mark was the picker of the sole stock that has a positive relative return. The way you read that number, folks, is that's how many points the stock beat the market by during the time that we've put it in this imaginary portfolio. So over the last 12 months, British Tobacco has beat the market by 9.4%. The annualized return for British Tobacco is 9.8%. And if you do the arithmetic, that means the market itself year over year has only been up 0.4%. Not a very high market, but certainly our choices did not live up to even that modest gain.
Ken, I feel that I should point out something here, that this is just a 1-year thing, and yeah, we did leave room for improvement, but we actually make these selections knowing that they're going to be around for a while. So really, it's just a matter that these are all works in progress for the most part.
We hope so, because we're long-term investors, and we like to demonstrate that by keeping track of all these numbers. Like I said, we have data going back to 2008, and we've been winners pretty well. Here's our big picks, and again, the way you read these numbers is relative return is how much the stock beat the market. So for our best returner, Wingstop, you can notice that it has a relative return of 61%. The market returned 7.8. That means Wingstop actually returned 68.8%. A pretty good return since 2017. And you can see when these were chosen and what we were doing at that point. So there's some pretty decent stocks on this list, and we're pretty proud of the winners. If we're going to show you our losers, then we're going to show you our winners as well. Mark, did you have something to add?
I was just going to say I didn't pick Wingstop. I'm curious as to who did.
You're welcome.
Oh, there it is, Mr. Donnelly.
All right, Pat. Okay.
Along with Viva.
Did you pick Viva as well, Pat?
I did.
Okay, I know Simulations Plus is my pick, and I know Amazon is Hugh's pick. When Hugh picked Amazon in 2014, he was laughed at. So Hugh, you have the last laugh for this particular stock by far. So without belaboring the point, let's move on to the next slide and get this panel underway, okay? We're going to start with Hugh McManus. Hugh comes to us from Pasadena, California, and his job involves dealing with drugs and drug companies. So he knows of what he speaks when he talks to you about Immunogen. Hugh, it's yours. Take it away.
Hey, thank you. Thank you to all who laughed at Amazon. But I do enjoy humoring people, and maybe Immunogen here will humor a few people as well. Well, one of the big challenges, of course, when you're dealing with pharma is the number of unknowns. And certainly, the future, as Alan Greenspan once said, very profoundly, that the future is fundamentally unknowable. But that doesn't deter people from investing in drug companies and from drug companies investing in high-risk ventures such as Immunogen does. So let's skip on to the next slide, slide 6. And this isn't an example of a company that's good to invest in. I tend to like these early stage pharmaceutical companies because when they work, that is when the stock price goes up, it can go up quite dramatically. It also forces me to do a significant amount more homework studying these companies. Very often, when I run into a company like a Pfizer or a Merck, you definitely look at sales, you look at profitability, earnings, etc., all of those details. And yeah, you dig into the company a little bit, but you are forced to dig into every detail of these emerging pharmaceutical companies, these biotechs, because they really don't have earnings, if you will, to I'd say to distract you, but that's a bit cheeky to make a statement like that. The other advantage of companies like these is it's not a company that I'm going to hold for a long time, but if it performs well, then I get money that I can invest in quote unquote real companies for the long term. And I like to try to profit from inflection points and using the clinic. If something was bad in the clinic, you find out why to see if there can be a turnaround. And in this case, I think there will be a turnaround. We skip along to the next slide. And it'll just describe a little bit about Immunogen. It's a biotech company. And biotech generally is used to mean it's a non-traditional pharma company. It's not one of the big legacy pharma companies. Generally, it doesn't have positive earnings. I like to say the company's earnings challenged, but it hasn't generated earnings, and it has been around for 35 years. I first became aware of it in 1991 when the Nightly Business Report made the comment at year end that if you had invested in any company that begins in immuno or ends in gen, your investment would have at least doubled. So I checked to see what Immunogen did back in 1991, and indeed, more than doubled back then, as did a lot of companies. It develops what are called antibody drug conjugates, and just briefly, I'll describe what those are. You've heard a lot about antibodies recently. These are proteins produced by the human body, and all mammals and other animals produce antibodies, and they go after something highly specific. Often called an antigen. They can go after small of your body, but they're flying after one thing.
Ken, are you live?
I thought it was me.
I'm live. Hugh, we are having some serious sound problems right now.
You just skip me and I will dial in.
Maybe we try. Yeah. Well,
all right. Hugh has asked us to skip him, and we'll come back to Hugh. So let's go on to our next presenter. And that's a picture of Lincoln. I know that Mark has a grandson named Lincoln, so I'm assuming this is Mark that's going to be presenting about beer.
it's a little bit of a tribute to Lincoln. I hadn't thought of it that way, but yeah, I have a grandson named Lincoln. Good stuff. Well, you can read the quote. I think it fits today's situation. And the point is to bring them the real facts and some beer. I got that off of his Twitter account, by the way, so he's staying pretty current. All right, let's talk about beer. It's not something that I would normally do this much of, but been sheltered and quarantined for a while, and got to say the refrigerator gets raided every once in a while. This is the price chart for the company with the ticker symbol BUD, Bud. And you can see that stock price has taken a real dive. It's basically back where it was 10 years ago. And it's finally reached in a long-term chart of the relative strength index, the RSI, the point where it's become pretty oversold and potentially attractive. Here's a look at what's been going on with the company for the last 10 years. Not exactly up straight and parallel, although it had a really nice track record as Budweiser Anheuser-Busch coming up into the 2000 to 2014 time frame, and then they went through a serious acquisition of Miller, SAB Miller, and they were just finally getting that stuff all kind of sorted out and things going in the right direction. And this hit. The coronavirus, COVID-19 thing hit, and now they're struggling to figure out what's going on. So again, those two animal mascots, are shaking their heads a little bit and hoping for better days ahead. Here's just a quick reminder of how ubiquitous this company is when it comes to selling beer to people. I'm not a beer drinker myself, but you can see the Anheuser-Busch masterpiece in the middle there, along with things like Stella and Michelob Ultra, and there's an IPA in there, and they just continue to have the types of beers and the ability to serve a lot of people. They're in the process of modifying their portfolio to make sure they're always doing their best job there, and they are in the process of picking up the Craft Brew Alliance literally as we speak. So there's probably some on there that some of the people in the audience actually know and consume. Maybe InBev. Okay, here's a closer look at the situation at the company. Again, it's kind of sorting itself out. This is a well-managed company with a long heritage and history. If you look at the red trend line through the sales results, you're talking about a very bland, relatively flat growth rate. This is not an exciting growth company, but it is a fairly steady demand over history in that 2, 3, 4% range, and certainly have brighter days ahead. It is a very profitable company historically. You can see down on the lower right that the margins have been in the mid to high teens historically, and there's no reason to suspect that they can't get back there. In fact, they believe they're in the process of doing precisely that. The thing is, though, you look at their current reporting on their conference calls and that kind of stuff, they actually had a coronavirus task force about a month before the government did. And they've been, working this situation in a global manner for quite a long time. So they're going after this. So you're basically looking at a company that's, again, ubiquitous when it comes to drinking some beer. $50 billion company in all, growing at 2 to 3%. Very decent profit margins in the mid to upper teens. A very respected PE ratio, somewhere in that high teens to 20 area. We'll call it 18. Under those conditions, knowing that the company sold for, the stock price was almost $82 back in January, it's been cut in half like we saw on that chart. And so with basically getting their house in order, stock price cut in half, making a product which this is probably going to have some demand, we're looking now at a company with a 19% projected annual return. And again, if you look at the low forecast on Value Line, they're even a little more ambitious than that. So pretty decent situation. And I'm going to throw that one on the pile. And, for those of you who laughed at British Tobacco last year, my Vice stock last year, here's another Vice stock that has a chance to be in a pretty good position a year from now. And with that, I'm going to do a little field research here. Could you all hear that?
Good
actually
man.
doing a little field research on one of the products. And I'll sit back and let somebody else take it away.
And Mark, if you can go back to Hugh's slides, I have a message that he's on a phone right now, so we should have better sound.
Go back to where we left.
You can hear me now?
We can hear you, Hugh. Go ahead.
Excellent. So that's Budweiser. So that's one biotech company.
We need to shut off a second microphone, guys.
Hugh, you have two mics on right now. You have to shut the other one down.
I believe I silenced it. Oh, I can hear myself.
I hate when it happens.
I don't know why this is happening.
Getting like a repeat.
Because
It's the beer. We hear two of you.
Yeah. I'm far away from the phone.
Okay, there's no echo
now it
right
seems to
now,
be
Hugh.
working.
We're fine, yeah.
I'll go with it
Come
now.
on. Okay.
So, Budweiser obviously is a biotech company. Let's face it, be honest about that. Just so you know, Guinness in Ireland was performing biotechnology on yeast back in the 1970s. It was one of the pioneers in biotech. And of course, that industry, brewing, is, well, it's hundreds, thousands of years old. It's credited actually with triggering accounting. The echo is back. I have no idea what's going on here.
Okay, let's go to our third presentation and give Hugh a chance
Hold on,
to see
let me
if he
try
can.
this.
All right.
Someone unmuted me on the computer. I was muted then. So it's gone, right?
It's
Sounds
gone,
good.
right? Okay.
Perfect. So what I was saying earlier was that to explain what an antibody drug conjugate is, the antibody is something, a protein produced by the body, which is very, very specific to an antigen, a target. It will go after one cell and nothing else. And in fact, antibodies can actually go after a single cancer cell, a single type of cancer, and nothing else. A little bit trickier to get an antibody to do that because the cancer cell itself is produced by your own body, so it bypasses some of the human body's natural defenses. But what scientists came up with 30 plus years ago, 35 years ago, was the idea that if we can get a poison, and I mean, I know people giggled at the president with bleach, but if we know bleach can kill cancer, it can kill viruses. The trouble is that it's hard to get it into the body without doing a lot of collateral damage. It's actually impossible almost, except if you were to conjugate it to an antibody. And what an antibody drug conjugate is that you take a highly poisonous small organic molecule that under normal circumstances would be absolutely deadly. A drop of it could wipe out whole neighborhoods. But you have it in small picogram or nanogram concentrations, and you fuse it or bind it chemically to an antibody, introduce it to the body, then the antibody heads after one specific problem, one specific type of cancer cell. It downloads the payload, the poison, into the cancer cell, which the poison then goes along to destroy it. And that technology has been evolving over 3 decades, and there are now 5 or 6 drugs in the market that perform quite well against cancers. One, which licenses Imugen's technology, is sold by Roche. And Imugen is using either partnerships or its technology with other major pharmaceutical companies. A non-exhaustive list is provided there. Now, if we move on to slide 8, it's just a diagram of an antibody, that colorful molecule in the middle with orange, with yellows and purples, etc., different domains within the antibody, and the small cytotoxic, as it's called, molecule that's linked to it, connected to it. It goes inside the cell, and there it chemically disconnects from the antibody and does its damage in the cell. The technology has evolved so that there's very, very little collateral type damage. In the past, they found it difficult to find antibodies that were specific just to the cancer, and the protein that they were targeting was expressed in some healthy cells in the body. So as a result, you got toxicity from early clinical trials. They had problems with the linker, which connects that poison to the antibody, breaking off too early. That now has largely been solved. And then, of course, since there are many sites on the antibody where you could stick a small organic molecule, sometimes they overloaded the antibody with these molecules. It went into the cell, it did its business and destroyed the cell, but there were a lot of cytotoxic molecules left over that didn't have a chance to do any chemistry, and then found their way into the bloodstream and did damage elsewhere. Again, all those sorts of things over years have been worked on, and now this technology is mature and ready for prime time. And while there are only 5 or 6 drugs in the market right now, there are over 200 to 300 in the clinic, and many of them are in phase 3 and looking promising. So let's skip along to the next slide. And that just shows you Imunogen's pipeline. Their background technology is licensed to a lot of other companies, so they do have a bit of a revenue stream from that. But you can see that the molecule on the top, the MAB, is a monoclonal antibody attached to a small organic molecule, the thing that ends in INEE, highly poisonous molecule under normal circumstances. And the next slide will show what has happened to the price, because it had a problem in the clinic about a year ago, and it had another issue recently. but the price has stumbled, and obviously it got caught in the downdraft from the coronavirus as well. It got corona. So the next slide will show what has been going on, what happened. It missed the endpoint of a pivotal phase 3 trial, a trial that would be used to support a filing with the FDA for marketing approval. And what happened, in summary, is that they made a mistake. They made a huge gap in going from small scale to large scale, and they made a mistake which called a bridging study. Basically, how they recruit patients, how they identify which patients should be in the clinical trial, they overestimated that, because the bridging study, they use the analytical test to identify people with the appropriate cancer, did not actually work as well as they thought. Diagnostic tests are really hard to get right, and you need to improve that. When they did a retrospective analysis of their data, it turns out that the drug works. However, the FDA will not accept the trial retrospectively. You have to prospectively say what you're going to do it, and then demonstrate that what you said you were going to do, you actually have done. So they have worked with the FDA to formulate a brand new trial. They have a better way for screening out patients for the trial, and they're moving forward. And this phase 3 trial should be all wrapped up within a year or two, at which point they can file for marketing approval, and fingers crossed, it should work. But the entire program has been delayed by 2 years because a statistician made a mistake. I'll blame a statistician, not a science. So skipping on to slide 13 for good luck. Oh, that's it. Sorry, I got rid of my conclusion slide. All I wanted to say is that yes, it's a risk. It's a biotech company, just like Budweiser, different type of biotech company, but it is a risk. But I think I see upside here, and I would use it to invest in something else if it works. So I will go on mute again.
Thank you, Hugh. We appreciate that. Kim, you're
unmuted.
You're going to talk to us about Vectrus. Kim Butcher.
Hi, guys. I'm going to present Vectrus. It's on the New York Stock Exchange at VEC, and this company gets 68% of their contracts from the Army, 23% of their contracts from the Air Force, and 4% from Navy. They cover a little bit of everything, and whenever we had the coronavirus and the military hospitals were sent to the East and West Coast, this company was the company who got all the supplies together, managed everything so that they could get there with everything they needed. So they use the supply chain and logistics, all the technology. So they do all that with it. And next slide. They have a huge pipeline of their business, and you can see how they've been able to grow it in the small slide in front of you, but even more so, look at the backlog they have. They have a total backlog of 2.7 billion and of funded, and over 4.5 billion of underfunded. And that just means they've got signed contracts, and the Department of Defense just needs to get the money to be able to get these projects going. And when you've got a backlog that well, now one of the things that I found this stock at my local library by looking at the value line sheets, and they have a special situations report, and I found it on there. And when you read the fine print, they said they were modeling for earnings at $4.50 a share next year and $6.75 by 2023, 2025. And they see the growth almost being 10% per year over that time frame, and that they believe it's going to reach the growth of 2.5 billion in revenues by 2023. Now, 2023 is just 3 years from now. So adding it all up, they think that the stock could be over $90 a share by 2023 to 2025, doubling in price, and no one's going to complain about that one. Like I said, I found this free on my library website. So in doing my SSG, where they figured an average annual growth rate of 10%, I picked 9 because they said overall it could be anywhere from 8 to 13%. I was conservative. On my earnings per share, they said they could have earnings per share of 675 going 5 years out. I made it much lower. I don't know what's going to happen in the market. I don't know what's going to happen in the Mid East. They have 68% of their business has been in the Middle East, 22% in the US, and 10% in Europe. So it's all over the world that they have this. This company's been in business for a long time. They seem to be really good at what they're doing, but I don't know what's going to happen. I'm not going to even guess. So they think it could at least be $90 a share in 5 years. So my SSG, when I did it, you can see it was 3 to 1, and the closing price was at $47.40 when I did it. And today the stock price closed even less. It was at $42.89. Next slide. Now, I was talking to Mark about this, and he was pulling numbers, and he got Y charts because he has access to that, because this is not in the database yet. So he did a study on this stock, and going forward, considering what they're putting out there and all, it looks like this stock could have a projected annual return of 16.6%. That's pretty good because it's over our 15%, and that's what we want. Next slide. Oh, big news is on the company. They just signed on April 30th a contract with the Air Force for $6.3 billion and definitive delivery and infinite quality for worldwide contingency construction and humanitarian support. They're getting the contracts. And as they get these contracts, and one of the things that they just did an acquisition. And in the acquisition that they got for the company, it is only one of 3 providers that the government uses for some of this disbursement of supply chain and needs of getting things that are done. So that's going to help them grow on forward. So here I like to look to find out, do the insiders believe in the stock also? Because are they purchasing it? Look at this. As of May, they've had 9 insider purchases and only 1 sell. Now, this stock had a nice pullback in May. Had never heard of it, so I'll be keeping an eye on it in case it does. But it went down to $29 a share. And as this is from Yahoo Finance, you can see where it was. And it's already bounced up. Got as high as $53.83. And today it closed much lower at 42. I think this would be a stock that we should all keep an eye on. And as Mark has showed us always, it's good to look at the RSI. The RSI on the stock today, when it closed at $42, it closed at $42.89. The RSI was 42.23. So I think it definitely could be a stock for anyone to consider for their portfolio. And considering that the Department of Defense uses this company quite extensively, and it's got a long history, if you're wondering whether or not the political environment could change, whether or not these contracts go through, I really don't know who's going to be in office, but I really don't think all the issues that are in the Middle East, where a lot of this deployment is going on, is going to go away, bing, and we're not going to have to be involved. So I hope you guys would consider Victress as one of your stocks.
Thank you, Kim. Appreciate that. Our next presenter is Cy Lynch out of Atlanta. Cy, we're used to hearing you talk about EPAM, so fill the audience in about EPAM.
All righty, let's talk a little bit about EPAM. It looks like I'm wearing my Atlanta Braves tie in that picture, and I will just start EPAM by saying it is not Cognizant Technology, CTSH. Those of you on the panel knows that is an inside joke, and many of you familiar with the Investors Roundtable know where that's coming from. Next slide, and let's talk about EPAM. Here's a picture worth 1,000 words. Wonderfully strong, consistent sales growth line. That's the top line over the last 10 years. And I'll go ahead, for those of you who know nothing about EPAM, it's a digital and programming engineering, software engineering and consulting company. We'll get to a little bit more detail in a few moments. But you see quite consistent record with the exception a little bit of tax issues going on there in 2017. And to be honest, I don't recall what happened back in 2011 with the margin, but of course that was coming out of the recession. Next slide. Since I got booted out of the Saturday afternoon screening presentation, I wanted to show a couple or one of my favorite screens. This is from Manifest Investing. You see the criteria that I used up in the upper right-hand corner. Projected return of 17%, which is just a little bit under the 5+ the market goal that we have. Excellent quality of 80 and a good financial strength, very solid financial strength of 70. The results I sorted by both quality and by growth, and you see that EPAM was the top in both. So it's the highest growth company at over 20%, according to the Manifest screener. Next slide.
Cy, I'm going to interrupt you and make it clear that you are not booted out of that panel on Saturday. And in fact, all the panelists on tonight are part of that last class about my favorite screens. So we hope to see you then.
Oh, my goodness. I wasn't aware of that, or it had flown by me or something. The COVID fog must have impacted me.
No booting.
No, no booting. Thank you, sir. All right. I will not take my toys and go home then. We'll continue. Just a quick industry study. The technology and information services sector. I ranked those by projected return, as you can see, and then notice that all of those with better returns projected according to Manifest Consensus than EPAM are not very good quality companies using the Manifest quality rate ranking, and those below EPAM also aren't particularly high quality, with a few exceptions to include a couple of favorites, Cognizant Technologies and Infosys, but their return is less. Next slide.
Cy, I know we're not fielding questions, but I just got to ask, does this screen actually come up every time you start your computer?
Yes, it does.
It's your home screen.
It is my home screen. In fact, I was going to mention, thank you for that entree, Mark. This is a little bit of a mini roundtable presentation in some ways. This is much the format I use for the roundtable. For those of you who have not yet attended a roundtable, we hope to see you at the next one. EPAM systems, this is just a little bit more detail on it. As I mentioned, they're a product development, digital platform engineering, and digital design company or agency. They started out as software engineers and have added on some other things. Probably the biggest difference between them and Cognizant is their market. They have a broader market target markets, I guess, which I've got a slide in a second on that, than Cognizant has. And also Cognizant and Infosys are more consulting than EPAM. EPAM's a bit more the developing and engineering, though they're getting into some of the other areas. They're in over 30 countries. about 60% revenues in North America and US, and about 30% in Europe, with a smattering in Asia and the Far East. There you see their industries, and it's one of 4 companies in each of the Forbes fastest growing public tech companies over the last 7 years, and it's been ranked on Fortune's fastest growing companies. Next slide. Here is the segment by industry. That's one of the reasons I picked it tonight. Look at the bottom graphs you see spread between financial services, travel and consumer, software, high tech, and the others. Emerging are simply their market segment for new customers that don't fit in the other areas. Notice it's pretty diversified. And notice again, coming out of the coronavirus and so forth, you're in a broad spectrum of industry, some of which will be impacted more by the virus and the shutdowns and the like than others. So it is fairly well positioned to weather the storm. Next slide. I just like this slide when I do EPAM, because they deal with the market leaders in their markets. You see 5 of the 10 largest investment banks, the largest online travel association and hospitality company, all 4 of the top broadcast networks and many of the TV networks, cable, 9 of 10 of the top pharma companies, and then independent software vendors. They hit among the 30 of the top 100. Next slide. Here we're back to the picture that we started with, good consistent history. I'm projecting a 22% growth rate, which is a little bit below the historical of 28, but certainly very achievable because it's not showing much signs of pulling back. And notice it's right at 2,300 million or 2.3 billion shares. Again, much smaller company than a Cognizant or even an Emphasis. Next slide. And then my judgments lead to a 11.7% projected annual return based on an average PE. That's relatively conservative judgments. My high PE projection off the stock selection guide could go as high as 18%, and manifest consensus projected annual return is 18.3. So I think it's worth taking a look at.
Yeah, those type of companies always are.
Thank you so much, Cy. And let's move now to Pat. Pat, you're going to be talking about Teradyne.
Yeah, one of the great companies from apparently the space race, because anything named Dyne had to be created during that period of time. So Teradyne, TER, was founded in 1960. It's a leading global supplier of automation equipment for the test and industrial applications. They design, manufacture, and sell automatic test systems for semiconductors, for wireless products, for data storage, and complex electronic systems. All of these are used in the consumer electronics, wireless, automotive, industrial, computing, communications, and aerospace defense industries. So when I was looking for this company, I was looking for technology, and in particular, technology that was not tied to any specific demand or industry. Coming out of the COVID-19 or coronavirus era, I feel that there's going to be a lot of technology changes being implemented. People that manufacture and produce them are going to be under higher demands, and this company helps them not only automate but test and improve their products. And as it says, they automate 2 of manufacturing's most critical elements: repetitive manual tasks, and the electronic test. Next slide, please. So the menu in the upper right here shows how the company's products are aligned. They basically have two large units, test solutions and industrial automation in their business segments. Semiconductor test products, this is where they test what's called system on a chip, which is basically an entire computer, if you will, that runs on a single piece of semiconductor or silicon. So they test during that manufacturing process where they help improve and control quality. This lets the manufacturers reduce their time to market. It increases their production yields, and it'll improve product performance overall. They have another section that tests the commercial board systems, which are basically the printed circuits, the circuits themselves, and then also they use 3D x-rays to examine the boards that are produced. All of that basically are consumed by cell phone manufacturers, companies that manufacture servers. So you have an internet theme here. All of your personal computers, pads, and phones, as well as internet switches, the communication gear that ties the internet together. Automobiles. Fun fact, my son informed me, he's a mechanic for Chevrolet. They have, on average, 64 computers in every automobile that's produced now. And I'm sure that number is only going to increase. And also avionics, so obviously airplanes and anything that flies. They also test storage, so anything that requires a hard drive, laptops, notebooks, again, consumer electronics. There's a drive to increase the density of storage, so manufacturers are continually looking for new ways to develop products. Those products need to be tested and they need to be quality checked. And also they have a military aerospace testing area that's used by the Department of Defense across all branches of the military, as well as allied military services worldwide. They have demand for high performance systems from tactical aircraft all the way through missile systems. And then specifically, they have a wireless testing segment that focuses basically on the two categories of cellular wireless and then the Wi-Fi wireless. So if you start thinking about 5G, as everybody hears, there's obviously a new push to create products for that. Again, they need tested, they need checked. So there's a large growth expected in this particular area. Next slide, please. This is a new term I learned about recently, cobots or collaborative robots. And this is basically robots that work alongside of human beings so that those humans are more productive. Particularly, Teradyne has acquired a company that is called Universal Robots. Used to be its own company, but Teradyne bought them in 2015. They've also made two other subsequent acquisitions over the last couple of years to complement that purchase. Next slide, please. This is where we click twice, Mark. So for our SSG users, what you're seeing is the standard view of sales, earnings, pre-tax profit, and your price bars. Looking at the SSG trends, the obvious question is, what happened in 2016? The primary impacting items I can find in their company's annual report was that there was an earthquake in 2016 in Japan that destroyed a production facility for the company. Totally took that particular production facility out. Additionally, the company was going through a reduction in staffing in the wireless testing area at that time due to decreased demand. The takeaway here, though, is we can still see that revenues were still increasing, even though they reported a net loss for that year. Next slide, please. Here I've, on again, the SSG visual, I've taken out, and now what we're looking at from top to bottom on the trend lines is the shares outstanding in the light blue. So we've seen that the company has been, had been acquiring its own stock, which has been a very popular trend for a lot of companies. The next line down is the free cash flow. We can see that the company has been generating free cash flow, and it's doing so in ever increasing amounts. Upwards trends are always good on this particular part of the slide. Net income number is the orange one. There we go. So net income has been increasing for the company. And we can see that in 2014, they started paying a dividend, which they not only started paying, but they have continually increased or have a habit of increasing that. So all good looking things here. And then again at the bottom, there's the table of the pre-tax profit, which was charted previously. Return on equity is strong. The green indicator is good. Debt to capital, even though that's flagged as red here because it's trending upwards, that could be because of the acquisitions, but it is well below the industry average when you look at the rest of the industry. Next slide, please. Okay, got to catch up with you here. Okay, so this is a one-year chart. It's not as pretty as everybody else's charts, but it gets the point across. We can see here the trend over the last year or so. Obviously, the company is not immune from the coronavirus, but it has recovered nicely, as we would expect. And it's continuing to hover here in the April to May, where it's kind of performing flatly. The company guidance is that they see 20 and 21 as being strong years, and they actually increased their outlooks. However, for the near term, the company is not providing any guidance in the next couple of months to, next quarter or two. So I think that's sort of taken away from the enthusiasm, so to speak. It may be an advantage for us. We can see the relative strength, the second chart down where the company is. It's not overbought, it's not oversold. We can see also historic PE ranges of the stock. So we see that it's basically the PE range currently is sort of in the middle of where it could be over the life of the stock, and at the very bottom where the current PE ratio lies. So it's in that lower section. If you're not sure, I take these as good things. Next slide, which I think is my final slide. They told me since I was new I had 1 minute and 35 seconds to get through all these slides. So I did my own SSG, but I'm not going to show that to you. I did transfer what I learned there into the Eagle. So under good conditions and over the long run, this company can make a compelling case if you use your own judgments. I could see Mark getting ready to point out the projected annual return of 17.3. And then nobody's given a nod to the sweet spot indicator up at the upper right. So we're kind of getting close with this, but you need to make your own judgments. So my closing statement would be that the argument for TER is that they are in the middle of helping other technology companies test and verify the quality of their manufacturing processes. The industry demand is strong, and their end products from all these industries span all other industries. That will do it for me on this one.
Thanks, Pat.
Thanks, Pat. We appreciate that. And I'll move on next with my presentation on General Dynamics. I'll start by saying this is not the kind of stock I normally study. I don't search for dividend, although this stock pays a nice dividend. But I do look for a thesis, and I think that General Dynamics is an example of the baby being thrown out with the bathwater. Let me try to make that case for you. Next slide, Mark. First of all, a little bit about the company. They operate in 5 reportable segments: aerospace, combat systems, information tech, mission systems, and marine systems. That marine systems is basically dealing with submarines. The aerospace is basically dealing with small jet planes that they make for private customers. They also have about 25 to 30% of their business in the defense area, so they have contracts with the government for a lot of confidential, a lot of different systems that they don't report on directly, but you do have a sizable component that is paid for by the federal government. Next slide. If you take a look at the price bars, these price bars are not looking the same way that the price bars did on a number of the companies that we've looked at so far. If you watch the price bars on Teradyne, you did not see the bottom fall out of that stock, for example. But if you look carefully at the price bar in the most recent year, the 2020 price bar, you will see that the bottom fell out of this company completely and has only recovered about halfway to the 52-week high, not even halfway. That's the red tick mark, up about 40% on the bar right there. I think that a lot of stockholders said General Dynamics, airplanes, sell the stock. And that's the thesis that I think will allow this stock to come back relatively quickly, along with another fact that I'm going to present in just a moment. Before I get off this slide, however, I want you to notice that the company has definitely changed growth characteristics as far as sales are concerned in the last couple of years. Sales had gone from around being flat to growing by greater than 10%, and the sales seem to have basically caught up with what the earnings had been doing for quite a while. Next slide. This is the other reason why I think you're going to find that as soon as investors discover why the company was having some of the issues that it had with earnings on this quarter and will have on earnings next quarter, I think you will discover why people might come back to the stock faster than some others. General Dynamics makes these Gulfstream jets, and it has a number of the Gulfstream jets finished and sitting on the ground waiting for delivery. 11 of them were ready to be delivered during the first quarter of this year, and because of the shelter in place restrictions, the travel restrictions, General Dynamics was not allowed to deliver those 11 planes. And since they weren't delivered, the accounting rules did not allow them to count as part of earnings going forward. That resulted in an 18-cent variance from where the earnings should have been if those planes would have been delivered. Well, those planes didn't disappear, folks. They're still there. And that 18 cents is going to fall to the bottom line at some point once those planes do get delivered. They have since raised that backlog of planes sitting, waiting for delivery, and General Dynamics is quite insistent on the fact that these customers are still there. They still want the planes. And the analyst community makes a very interesting point that while the need for airplanes such as the ones Boeing might be putting together or the ones coming from Europe, these planes are meant for a completely different customer base. And in fact, the very idea of flying commercial might have some people in some of the larger corporations so worried that that would be an accelerator of General Dynamics growth in the Gulf Stream area rather than a depressor. So we'll see if that comes true or not, but I do know that these planes exist, they're finished, they're just waiting for delivery. Next slide. I'm looking at what you normally look at the bottom of an SSG, and what I see that might be a little bit troubling to me is the debt levels. I went to the Morningstar page and I looked up interest coverage. I found that interest coverage was at around 10 or higher for the last 5 or 6 years. And I know as a fact that interest coverage greater than 8 is considered a good number. So while that debt number is a little bit high for this particular company, the interest coverage seems to indicate that it's not going to be bothersome to their balance sheet. Next slide. Using sales growth of only 4.5%, which is extremely conservative, and earnings growth of about 5.5%, again, very conservative, with a high PE of only 16 and a low PE of only 12, using a payout ratio of about 35%, and choosing the recent severe market low as my estimated low price, I get a good solid buy. I get a total return, a high return number of around 16%, and a par number, an average return number of around 13%. All of that with a dividend that is substantial. It's a good, solid dividend. And so I think General Dynamics might be something that I'm seriously going to look at putting into my portfolio. Let's move now to our lightning round. And we're going to do a lightning round where we're going to try to each stick to about a minute or 90 seconds and give you one more idea before we call it quits for the night. So we'll go back to Hugh. And Hugh, I recognize the duck, so take it away.
Sorry there. I had to...
There we go.
Yeah, I know. I just was unmuting the wrong thing. So maybe I was overcompensating for what happened before.
All right.
So yeah, I love this slide and I love that picture. The late great Tom O'Hara. And so I've been asking recently, particularly with the change that's been going on thanks to COVID-19, fewer cars on the road, so fewer accidents, and insurance companies actually rebating money. And I thought, well, gosh, what would happen if these promises of driverless cars actually occur? They won't call them driverless, they'll brand them as something else that's a lot more innocuous and just weeks of safety and reliability. But the fact of the matter is that there will be far fewer accidents when it happens, especially when they're interconnected. What will happen to insurance companies with all of these reserves built up for car accidents? And then a company like Aflac, which we all know and love, what will happen if the pharmaceutical industry actually delivers on its promise to cure or at least put a huge dent in cancer? And it's increasingly likely that that is going to happen within the next 5 to 10 years. There's a documentary doing the rounds right now called The Breakthrough. It's a documentary on immuno-oncology. It's well worth watching because it is signaling what is coming down the pike, certainly what's happening in the clinic right now. So I like Aflac. And it's been going through a bit of a problem right now with its stock price, at least. It is a global leader in writing supplemental insurance, particularly cancer, in its favorite old market of Japan. It's a darling of NAIC, as you just saw. It has a growing book value. Mark shared some information with me, and it's a nice chart, and I'll show you it in a second. But the stock price has been corroded because people assume naturally that if there's going to be illnesses and work loss, etc., from this coronavirus, that it's going to have to pay out money. I think I agree with that, but I think the stock price being halved and being held down is way overdoing what's likely to occur. So we skip forward. We can see on the next slide that, you hearing me okay?
Yes, I hear
Yes,
you.
we are.
Oh, perfect. Okay, so if we move on to the next slide, you can see, and I just have to get rid of this thing telling me that I'm muted. Sales are flat. This is not how Aflac looked back way in the late 80s, early 90s when I first bought it. The book value has been growing nicely, and this is probably book value per share. No, it's not. Its book value has been growing nicely, and the earnings per share has been on the increase, but nothing really dramatic is happening. The telling thing, of course, is return on equity, which has been on the decline. But all in all, when you look at the balance sheet of this company, it's in really good shape. It has a boatload of reserves, about $150 billion sitting on its balance sheet or in its financials. So it's looking quite good. And of course, it for many years has been borrowing money at next to nothing in Japan and bringing it into the US. Skip along to the next slide. And this is going to be brief, so I just put 2 or 3 slides together for this. This company certainly isn't what it used to be. And the share buyback program has become critical in bolstering the share price. But the dividend continues to be strong and growing. More on that later. It's hard to see how the stock price warrants such a whack based on what's happening with COVID-19. It will impact it, but not as dramatically, I don't think, as the stock price is saying. But the big thought I have on Aflac is have a lot of reserves built, particularly in Japan, against cancer. But as I said, what happens if cancer is cured? And that should be in quotation marks, because it'll become more of a chronic disease that's treated over the lifetime of the patient. Nothing like a wholesome cure. In some cases it will, but not in most, I would imagine. But what happens? What does it do with all that cash? Does it pay it out in a dividend? Does it lower premiums? Doubt it. I think it's more likely to be dividends. And I'm going to continue to buy Aflac whenever it's cheap for the long term, in the hope that things turn around and me as an investor can benefit from that. So I will leave it with that.
Very interesting.
Hey, Fred is here.
Thank you, Hugh. Fred.
Okay.
I think that's you, Mark, right?
I've gone from Lincoln to Fred. Well, I'm going to go at a concept from 35,000 feet. It's just simply the notion of we all like to drive. We like to ride in cars. I don't care if we are replacing them with driverless vehicles. There's going to need to be vehicles. You're looking at a very long-term chart of the number of automobiles sold. And you could probably put a 3% trend through that. It would look something like that. Notice that, yeah, the coronavirus, my wife is home. She works for Chrysler, Fiat Chrysler. She's working from home for the last couple of months. And yeah, that is happening. It will come to an end. It will come to an end. What you're looking at here is taking us back to the Great Recession. What actually happened if you add up the sales of all the automotive companies, put them on an SSG, you get what happened back then. Notice the recovery that happened back then, because that was really nasty back then. And it was a financial problem with mortgages and loans and all that kind of stuff. Here's what's going on now. I basically asked the simple question, is it possible for a trough like we're seeing now to heal itself fairly rapidly and return to something decent? We did this in the 1970s, back in the mid-1970s. We did it even more significantly back in 1938. We have done this before. I was thinking about bringing Ferrari here tonight, ticker symbol RACE, R-A-C-E, but the stock price has gone up so much. Here's a fun fact for you. The market cap of Ferrari is now greater than all 3 of the big 3. Did you know that? Ferrari, the market price, the market cap for Ferrari is greater than the big 3. That's just almost unfathomable. By the way, a Better Investing alum, Karen Dumas, led the release, the IPO of Ferrari a couple years ago. So I didn't want to go to the one company, Ferrari again being a bit overpriced. Why don't we buy them all? Here's basically that same chart. That could be the Budweiser chart, right? I'm sticking to a theme here. The price is where it was 10 years ago. This particular ETF, it's an exchange traded fund, means that you will be buying shares of Ford, Tesla, GM, Fiat Chrysler, BMW, Daimler. They're all in there. All the companies worldwide, they're in there. They've all been crushed because of what you see on that top chart. And again, the thinking is will it recover at some point? Probably not Armageddon. A little more detail, looking at the chart over the long term, you can see those financial moments that happened to the collective earnings of these companies 10 years ago, what we're going through right now, what the analysts think the recovery looks like. I actually take a little bit of comfort in seeing this profitability chart. Again, this is for all the automotive companies. Notice that back in 2008, they went negative. And as of right now, we're not even looking at a negative situation for the collective net margin. So again, I look at an opportunity like this with the stock price really stuck in the trenches to speculate a little bit. This is not a buy for a lifetime, but could be a decent opportunity. 15% type returns, maybe in the low 20s. So buy all the cars. You'll get some Tesla as a bonus. And with that,
Kim, let's enlighten us about Chubb. Kim, I think you're muted.
Okay, when I was asked to pick a stock and in 1 minute give a lightning round about it, my thought went to, I was seeing all on TV, all the insurance companies are talking about what their liability and their risk is, and it turns out I have a neighbor who works in the industry. I asked him the question. He said most property and casualty companies, they usually have something in there that it's loss of use, and loss of use is physical damage, and physical damage would be like if the restaurant had the windows blown out because of a hurricane, not because that the business shut down. Yes, there's going to be a lot of lawsuits. Whether or not they're going to have to pay any insurance out is another thing. So I was looking at Chubb, and what struck me is when I read the catalyst is I read where Director Robert Scully, he's a retired Morgan Stanley executive, bought $1 million of Chubb stock at an average price of $102.40 on May 1st. And that is the largest purchase of an insider since 2016, when he was the one who did it again. This company does have a low exposure to any workman's comp insurance, so they will probably have to pay some on that. But it closed at $98.51 yesterday. Now look at the 52-week high, $167.74. This stock has tumbled 40%. The low is 87.55, so currently it's only about 10-15% above the low. The RSI is like 40.3 as Mark talks about it. I can tell you that this stock has been, its book value in 2019 was 122.14, and going out on the value line sheet, they expect the book value to be 170. So I easily think that this stock price could go back up to what that $164 or $67.74 in 2 to 3 years. So in 3 years, you could get that back up. Their return on invested capital or return on equity is consistent, and it's supposed to be up to 10% by 2023-25. And if you're interested in dividends, they pay $3 a share in dividends. So that's my lightning round strike of a stock.
Thank you, Kim. I think that Cy is up next. Cy?
All right, I'm going to talk about hot stuff and cool prices. 5 below. Mark talked about a bit of a disaster industry with sales. and Kim touched maybe a little bit on it as well. This stock I presented in, I believe it was the March roundtable when all these stores were closed. Five Below has started reopening stores as legally allowed to, and as they get their new hygiene and procedural things in order, so they are rebounding. Next slide. Here's the history of the company. Again, very high growth, very consistent. Certainly, they're going to take a hit during this COVID time. However, they did have an online presence, so they were not completely shut down. One thing that is attractive about Five Below relative to perhaps some of the retailers like Neiman Marcus and J. Crew that you've heard declaring bankruptcy is they do have debt, but it's all capitalized leases. They don't have financial debt, it's lease debt. And again, given their past history, I seriously doubt that their landlords are going to be kicking them out. They probably have some leverage if necessary to defer a little bit of some of their lease obligations if they did have any cash flow issues. One just freebie I'll mention, you can expect, I think, to see retailers filing bankruptcy, but I bet that you're going to largely see their ones in trouble and that were on the down well before the coronavirus hit. And in fact, they're going to be doing the opposite of what Five Below's doing, which is finding new leases as they continue their store expansion. The ones filing bankruptcy are actually filing bankruptcy to get rid of lease obligations on underperforming stores. Next slide. Here's just what the company does. They focus on tweens and teens. Everything, as the title says, is originally Five Below. They've kind of stretched that a little bit to $10 now, but they are very experienced management and they have well-managed growth. Next slide. And here, this just gives you a little bit of the growth history of how they were increasing stores prior to this coming recession that we're in and the coronavirus. Also notice fairly good geographic representation that I think both bodes well once we're past this crisis, but also gives you some ability to start opening in various areas as well.
Thanks, Cy. We're going to move now to Pat. And Pat, Stone Company, a company that I'm not familiar with.
Yeah, new one here. I was talking to my friend Warren the other month on the phone, and son of a gun if he didn't invest in this company ahead of me. So this is a little bit of a vision, everybody. Wanting to share a vision and where you think it might be going. What we're looking at here, and put this in perspective of the coronavirus and what it means to the future. This is China, so it's a little bit of a story. In this restaurant in China, you can see the barcode at the bottom left-hand part of the table. There's no menus in this restaurant. You have to have a phone with you. But once you do, you go in and you scan that barcode on your phone, and what you're seeing is the menu on the phone. That's no big deal. But the way this restaurant works is you actually place your order, even though you're sitting in the restaurant. You use the menu that's on your phone to place your order. You can do it individually, as you see the person across the table, or you can do it for a group. And then at the same time, you actually pay for what you've ordered. So in this restaurant, there's actually not a cash register to be found. There's no dirty cash changing hands. It's all electronic payment, electronic banking. And that's the real theme here. So Stone Company is a provider of financial solutions. They have built a cloud-based technology platform to let them do electronic commerce for stores, online and mobile channels. The cloud-based technology means that they don't have a significant investment to overcome as far as spending money to get themselves up and running. And they've been around for a few years, as we'll see here on a chart that's coming up. What it does, though, is it's, to me, a preview to the future. Stone also is, it's a Brazil-based company. And what they do is they actually have what are called stone hubs. And they've dispersed hundreds of these stone hubs, which are local, physical, small locations where people can interact with the stone employees. So they have relationship building, they can answer questions, and build that customer loyalty. Behind the scenes, Stone is building a financial platform. Obviously, they build a payment technology. They sell that technology. They're also increasing, and they're going to move into the loans area and banking areas as well. Now, the reason we haven't heard of them is they're strictly based in Brazil at this time. So if we could take a next slide here, Mark. So Mark was very kind to put this together for me using his Y charts and typical methodology. But basically what we see here, one of the other things that attracted me, obviously the price of stone has been depressed recently, makes it very attractive. So, you know, $20 stock type of thing. For all of the better investing NAICers, don't get too excited. This is, as I said, a vision stock. It doesn't quite have enough history yet, I don't think, for most people. However, it's building a track record. It's something to get onto your radars so that you can take a look at it. A parallel company that you would be familiar with is Global Payments. I think overall in the payment industry, there's going to be huge changes that take place after things start to get back to normal here. Again, looking back to the left table in the green, we can see that you know, it's got a pretty good projected PAR of 22.9% so far. Again, draw your own conclusions. The debt is fairly low for a company like this. It's well run. Again, as I said, for those that are Warren disciples, he took a 5.1% ownership of this company earlier this year. So I like everything I see. I like everything I hear, and it definitely has me intrigued. So I'll be studying this one and its peers.
Thanks, Pat. And here's the last lightning round choice. It's me. I'm choosing AbbVie. I do own AbbVie in a couple of different accounts. AbbVie is a drug maker. Probably you would refer to it as a biotech, just the same way we talked about Immunogen earlier in the evening. Next slide, Mark. Here's the visual analysis. Keep in mind that we're looking at a company with a lot of history, fairly good sized company, and a really nice consistent sales line. AbbVie recently completed a merger with another large biotech company called Allergan. Allergan was domiciled in Ireland. It originally was an American company. The primary product from AbbVie is Humira, a drug for rheumatoid arthritis. About 60% of AbbVie's revenues in the current year are going to come from Humira, although they do have some really good big drugs in their pipeline and in the beginning stages of promotion on the market. The big product from Allergan are Botox products, both from a cosmetic point of view and from a point of view of acting as a potential medicine. If you want to learn more about AbbVie, there are some great investor presentations on AbbVie on their website, and I would urge you to go there, especially look at the one called Pipeline. They do a wonderful job of explaining the drugs in their pipeline, all the way from phase 1 trials all the way up, and including the ones that are just beginning to hit the market. Next slide. I did strike the 2018 PEs when I was looking at average PEs, and I'm noting that the current PE is below the 4-year average PE, current PE of under 16 compared to over 18 for the average. That's always a good indication in my mind. Next slide, please. That's my pick, AbbVie. I would suggest you take a look at it. Our next presentation will be on small company discovery, and that will be on tomorrow afternoon at 2 o'clock. If you need to register for that class, you can go to the Mid-Michigan chapter website, and there's registration links there, or you can go to Manifest Investing, and there are registration links there as well. Well, I'd like to thank everybody on the panel for their work for this evening. I'd like to remind folks we have a roundtable coming up on Tuesday, May 26th. You should have already received your first invitation to the roundtable if you are on our mailing list. If you're not on our mailing list, again, nkavula1@comcast.net will get you onto the mailing list. If you'd like to test drive some of the things that are happening right now with Manifest Investing, drop an email to Mark at markr@manifestinvesting.com. We'll be posting this video on YouTube at the Manifest Investing Roundtable site. And with that, thanking again all the folks on the panel, I wish you all a good night, and I hope to see a great many of you tomorrow at our first class. Good night, everybody.
Thanks, everybody.
Good night. Thanks.
Night.